Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I am here with two important people. One is our host, Robb Fahrion. He's the CEO and founder of Flying V, our digital marketing partner. And previously, George Soros is the man who has the reputation as being the one who broke the Bank of England. Well, DKI intern Alex Petro has become the second man to break the Bank of England. We'll get to that story in just a minute. But first, Robb, how was your week?
Week was great, Gary. Excited for Thanksgiving coming up here Thursday. Really looking forward to that. I don't know if Alex will be eating turkey like all of us, but maybe he can join in the festivities this week. Although it sounds like he's got a few bigger problems on his hands that we might allow him to explain about here in a second. But Gary, this week's edition, the Nvidia calms the market issue. Got a lot of strong topics that we're going to talk about in this week's Five Things. But why don't we jump to that first piece we've been prefacing with Alex and the Bank of England?
All right. So, everyone, Alex is one of our star interns, comes to us from the University of Exeter, and had a bit of a dust up with somebody from the Bank of England, which is one of the most powerful central banks in the world. Alex, what happened in your class last week?
I'm a second year at the University of Exeter. I'm studying economics and finance. And in one of my modules, money and banking, our lecturer, our lead lecturer, invited a guest speaker in from the Bank of England. And it was on a Friday evening. And boy, did I not let her have an easy Friday evening. No, so she came in, and there were quite a few people in the audience, and it started off. It was very interesting, and she was explaining kind of what inflation has been like around the world, how they've dealt with it, and saying that they've dealt with it very well. And she then goes through outlining all these other issues, such as climate change, inflation, geopolitical risks. And sh- I ended up in the questions at the end, I asked her about the elephant in the room, which was the debt. And so it was quite a long question, but the question I asked was, look, we've seen other central bankers such as Jerome Powell. He was on 60 Minutes, and he's obviously said that the US is on an unsustainable fiscal path. We've seen Stanley Druckenmiller, one of the best macro investors of all time. He's come out and said he's shorting the long end of the yield curve. We've had Paul Tudor Jones coming out and telling people to buy gold, tell them to buy Bitcoin. And whilst I'm saying this, she's nodding her head. And I said, this isn't to dunk on the Americans. We are in just a dire state as they are. And as Paul Tudor Jones said, it gets to a point where the inflation's baked into the cake, and there's only really one way out, which is to print your way out of this debt problem. And I asked her, is that what the Bank of England's going to do? And as someone who's staring at this, who's very concerned, what are your plans to mitigate the damage ahead?
Uh-huh. And was the representative from the Bank of England, did she understand the question? Did she accept your premise? What kind of response did you get?
So the previous question before me was it was a softball question, and then when I asked it, the room kind of went quite silent, and there was a moment's pause, and she goes on this kind of long, very kind of politically correct, what meandering down the story, kind of tale, explaining that, well, they look at the kind of the fiscal debt projections, looking at their kind of exogenous models, and she kind of, as I said, she meandered down the story, and she ended up saying, yeah, so kind of one of the solutions is to print our way out. But, and she finished with, but I am not speaking on behalf of the Bank of England. And so I just said to her, so you don't have a solution to this problem then? And she didn't give me an answer.
Yeah, well, I think the non-answer is very telling. I also think it's really interesting that the way they dealt with inflation, she's saying, oh, we dealt with inflation, we did a great job, it's all set. Except the real solution to the debt problem is going to be the thing that kicks off a gigantic round of enormous inflation. So it's her answer, I think, was very misleading
Mm.
and led people to believe they had things under control when all they did was kick the can down the road.
Yeah, definitely. And it was interesting because she prefaced kind of her whole presentation by saying that, look, monetary policy is very complicated, and she came up with this I don't know, this data piece or this statistic saying that they worked out that it takes 14 years of research to actually be able to understand kind of the monetary system. And so I'm not sure how many years she'd spent at the Bank of England, but it didn't seem like it had been 14 to me.
Okay, so let me get this straight. This person says you need 14 years of academic training to understand the situation, and yet a second year university student had her completely stumped, flabbergasted, and unable to articulate anything coherent. Am I understanding that right, Alex?
You are understanding that correctly,
Uh-huh.
yes.
And then I believe also they had video of the event that was posted and then got taken down a day later. Is that also right?
Well, so we have the lecture recordings for all our lectures for those who miss lectures. And so when I went to go look today, because I knew we were going to speak about this, it said that due to she's not speaking on behalf of the Bank of England, we decided that we're not going to upload this recap recording lecture for kind of privacy reasons, which I thought was interesting. But yeah.
Yeah. So my conclusion here is that a second year university student and a deep knowledge investing intern can completely blow up the narrative of somebody who's had 14 years of academic training and is a senior person at one of the world's most powerful central banks. That doesn't say much for the central banks, but I am thrilled to know that DKI interns are able to single-handedly take apart central bank representatives. Alex, we are proud of you for being subversive.
Oh, thank you. Thank you. Hopefully once I've done my 14 years, maybe I can speak to the facts better. I can be the one answering the questions.
All right. Well, just so you know, when you fail your class, there's always a place for you here.
No,
Yeah, and feel free to extend another open invite from the DKI Five Things, Alex, for anyone from the Bank of England or her as well. We've got a long laundry list now growing of guests we'd love to have come on the show. So just let her know.
Rob,
definitely.
that's a genius idea. Alex, can you reach out to her and ask her if she wants to come on next week's show? We would love to host her.
If she responds to my email, then yes, of course.
Alex, send her that email tonight.
Okay.
Get that out. We want this representative on, and we'll tell her. We'll make it clear from the beginning that nobody on the show is a representative from the Bank of England.
That's exactly right. Disclaimers throughout.
And we may have to yank the video 24 hours afterwards. But yeah,
Yeah, that's not going to happen. But you know, but yeah, extend the invitation. Tell her we would love to have her on, and would look forward to speaking with somebody who has such great academic training.
absolutely.
Try to say it in less of a sarcastic way than I just did. You'll handle it better.
Yeah, I'll try. I'll try.
Awesome stuff, Alex. Gary, again, this week's edition, Five Things to jump into it. The Nvidia calms the market issue. We're talking Nvidia earnings. We've got Walmart, Target, another macro environment update. We're talking TPL, as well as getting to another reader subscriber question from one of our DKI subscribers regarding hedging that we'll get to in our fifth thing. Gary, to kick it off, we're talking Nvidia. Their earnings are fantastic. The market says meh. Thing number one, Gary, Nvidia earnings. Tell us why the market didn't respond in a way that maybe everyone might have anticipated.
Well, Rob, for the last 2 years, every time Nvidia is going to announce earnings, Twitter or X gets all excited saying, here it comes, the most important earnings announcement of our lifetime. And it became sort of a running joke, a running meme, except there is some truth to it. Nvidia is now the most valuable public company in the world. It is the largest part of the S&P 500, the largest weighting in the NASDAQ 100, these huge market indexes. And for the last couple of years, that stock alone has been responsible for a huge percentage of the gains that we've seen in these market indexes. And so it started as a joke, but it's really not hyperbole that Nvidia earnings are important to the market. So they came out and they had quarterly revenue of $35.1 billion. That's up 17% from the prior quarter and 94% from the year before. That's incredible growth for one of the world's largest companies. The data center growth was up 112% year over year. And despite all these incredible expectations, Nvidia still managed to beat expectations. And they put up revenue and earnings that were above, where the street was. They gave incredible guidance. And, the CEO, Jensen Huang, said that the age of AI is in full steam. That's clearly true. And there's, good news coming regarding the Hopper GPUs and the new Blackwell chips, and everything seems to be going great. And yet the stock did absolutely nothing. It traded down in the aftermarket, then back up the next day. And basically across that couple of days surrounding this incredible earnings announcement, this great press conference, the stock was flat. It did nothing.
Gary, we're seeing that investors now, they want more than just records. They want acceleration. Obviously, there's increases AI related data center purchases, something for scale. But let's talk about a few of the downsides that you're seeing here and call out in regards to Nvidia.
So I think the key thing is that the company has a $3.5 trillion valuation. And in fairness, they have put up unbelievable numbers. But the reason the company is trading at, $3.5 trillion, the market cap, is because people are expecting 100% growth quarters. And that's those expectations are part of the stock price. And so when you have a company that only does 100% growth, but that's what's expected, it's hard to get the stock to go up further. It's an expectations game. The upside here is that these guys they're the best in the fastest growing area of the market, and there are a lot of people who justifiably believe that AI is going to be transformational. But the risk in the stock is pretty severe. That's because there are 4 or 5 companies, the hyperscalers, companies like Facebook or Meta, Google, that are spending tens of billions of dollars a year to buy NVIDIA-based infrastructure. And that's really expensive. And as of now, nobody other than NVIDIA really has a business model that would justify a return on the gigantic investment these companies are making. And so imagine a scenario where, if Google or Apple or Microsoft in a year said, you know what, we were excited about AI and we're still going to spend tens of billions of dollars, but we're going to cut our spending on, NVIDIA GPUs by 10%. We'll still spend tens of billions of dollars, but just a 10% cut from 2 or 3 companies. And there goes those 100% growth quarters. And so the risk isn't that these companies can't afford it. The risk is that their customers, that just a few of their customers may decide, maybe we should slow this down until we figure out how to make money on it. The final thing on this, and we've talked about this a lot on this program, is those AI-based data centers use enormous amounts of energy. And within the next year, we're going to start seeing individual data centers that use enough energy to power entire cities. And so the question is, where is that power going to come from? Because building energy infrastructure, just getting permitted for it, takes years. And so we could end up with a power shortage. It's one of the reasons why at Deep Knowledge Investing, we're so positive on uranium and nuclear power.
Interesting stuff coming from Nvidia. We'll be sure to stay in tune upon the next earnings for the company. Thing number 2, Gary, we're talking about Walmart, Target. Walmart comes out with a great quarter, Target with a bad quarter. We're looking at the consumer here. Thing number 2, Gary, consumer reality and shifting spending.
So we've talked a lot about the consumer and sort of this shifting picture. For much of the last couple of years, despite all the warnings about the bad economy we're in, for the private market economy, the consumer has largely spent and spent and spent. The other side of it was a couple of weeks ago. We talked about buy now, pay later, and the way the consumer is just running up huge amounts of debt. And so there is evidence that consumers are a little bit constrained right now, despite the fact that they're spending a lot. And I think the reason they're spending a lot is because necessities have gotten expensive. We don't believe for a minute that food inflation is only 1 or 2%. I don't know anybody who goes to the grocery store who thinks that's the case. And so consumers are spending more money on necessities, leaving less money for the discretionary items. And so what we saw was Walmart. They came out and they reported almost $170 billion of revenue, which was above expectations of 168. They raised their year-end sales guidance to about a 5% increase. Target, they missed revenue projections. They gave weak guidance and took down earnings estimates. And so here are these two gigantic US-based retailers, and one is putting up sales gains, beating numbers, raising guidance, and the other is going in the other direction. So it's really been a tale of two companies in the retail space this week.
Gary, how much of this has to do with what we say and have been saying is the dramatically understated inflation that we're seeing, consumers resorting to generally lower priced Walmart options, as well as Target kind of going through what you called an identity crisis and determining who their actual customer is and who they're catering to?
So, Rob, it's one thing that's great about posting our work in public is we get great comments on it. And in the 5 things in the written version, we had listed 2 factors contributing to this divergence between Walmart performance and Target performance. And somebody suggested a third. So let's talk about all 3. One is the fact that if people are constrained, if they're spending more money on necessities, then they're not going to be able to spend as much on discretionary purchases. And so, we think what we're seeing is a shift in business from the more expensive Target to the less expensive Walmart. And I'm also seeing a lot of data saying more people are planning on buying all of their holiday gifts at Walmart. People are looking for the low cost retailer here. The second thing is these two companies have positioned themselves very differently. Walmart, their mission is crystal clear. They are going to be the low priced provider. Walmart is the place that you go to spend less, save money. It's the place you go when you don't have a ton of discretionary income. Target, on the other hand, they've had more of a mixed message for their customers. And we've talked about this a lot, but for their own reasons, they have chosen to take on a lot of the most politically charged, controversial social issues in their stores. And it's led people to say they don't want to deal with it. And the American people are more and more coming to the conclusion that just get us great product at a good price, or, good product at a great price, just get us some sort of value. Consumers more and more are saying enough with the divisive other. We're not coming to Target for your view on social issues. And so, I think Target has turned off a lot of their customers, and they don't need to. The final thing, and this came from a really interesting investor on Twitter or X who sent me a message saying he disagreed with our analysis on it. And he made a great point. He said that this wasn't a situation where Target shoppers were shifting to Walmart, but rather a situation where at Target, you have a small amount of their sales on necessities, a large amount of their sales on the more expensive discretionary items. If you go to Walmart, they sell a lot of food. They sell a lot of inexpensive necessities. And he thinks that at Walmart, their sales of the higher priced discretionary items are down as well, but it's being masked by the fact that Walmart has a better mix of product for the current environment. So I think these are 3 really interesting, somewhat different ways to view the situation. For those of you, I don't shop at either Target or Walmart. For those of you who do, I'd love to know your thoughts on it. Put something in the comments. Let us know why you're choosing one place or another, what you're seeing, what your shopping experience is, and what you think is causing Walmart sales to beat expectations and be up nicely. And we're seeing the opposite of Target. Just put it in the comments and let us know what you think.
As Gary mentioned, please do leave a comment. We'll do some market research for Walmart and Target and be sure to deliver that to them right after this recording. As always, please head to our website as well, deepknowledgeinvesting.com. You can grab a free subscription and be notified of all new content being posted just with an email. And if you'd like, you can subscribe as a premium member. You'll get access to all of the paywalled content, current recommendations, when Gary's buying, when Gary's selling, and being in tune with everything market related, as well as exclusive subscriber events and webinars. Gary, moving to thing number 3. Last week, we released a huge ebook on the macro environment, which got a great response. Thing number 3, Gary, we're talking about that a little bit. Misunderstanding the micro environment. Check out our new ebook. Tell us more.
Yeah, so it's the macro environment, and we addressed all kinds of things that are really challenging for people. One of the things there's a misperception, and this is something that that Alex was dealing with the Bank of England. There are misperceptions on the true cause of inflation, and we talk about that. But not just, hey, it's really bad, we have inflation, aren't we all miserable? But what we're doing to profit from it. Remember, even if we have bad policy, even if we have things going on that we don't like, if you position yourself right in the market, if you position your exposure right, there are ways to make money from these things. And we talk about some of that. There also was that recent event where the Fed cut rates and bond yields went up. Now, that wasn't supposed to happen, except we knew it would, and we talked about the reasons, and we lay that out. We talk a little bit about why we think the Federal Reserve cut too soon. We talk about the fake employment data and the way we're viewing that, and the outlook on various policies from the election. It was written prior to the election, but the analysis still stands. And the most important thing is the book was written for people who haven't spent decades working in finance. If you're somebody who wants to better understand these issues that affect your home finances, that affect the checks that you write sitting at your kitchen table, and how you manage your household expenses and how you invest, this book was written for you. You do not need to be a 30-year hedge fund manager to understand it. We wrote it for a lay audience. And you know what, Rob? Just like you said, in under a week, it's gotten almost 40,000 views on X. We've had hundreds of downloads. And, the reason I'm so excited about that is, one, we've been able to help a lot of people and help them understand what's happening better. We haven't charged anybody for it. But the other thing is, it's an ebook on the macro environment, right? It's not this isn't like the Taylor Swift tour where 70 million people might be excited about it. And the fact that we've got hundreds of people saying, yeah, I want to read this, I want to understand more about it, I think is really exciting. It was really well received for a topic that doesn't necessarily excite people when they wake up in the morning.
Yeah, the book is jam-packed. I've been through it. Gary, what would you say one key takeaway, or maybe just one piece within the book that you'd like to highlight just here on this version of the 5 things?
Rob, I think there are 2 things that are important. One is, we are beyond the point where the problem can be fixed. The US government, the dollar is in full Ponzi. We are printing dollars to pay the interest on dollars we printed a year ago. That's not sustainable, and nobody's going to fix it. And I've said before, I am cheering for Vivek and Elon at the Doge, the new Department of Government Efficiency. I would love to see them cut trillions of dollars from the budget. I just don't think it's likely to happen for reasons that we lay out in there. But the key thing, and this is the message that I've been relaying to people for the past several years, just because I'm concerned about the environment, just because I have negative thoughts on what's happening, doesn't mean that we should despair and be unhappy and wake up and be miserable and go through your day horribly. There are things that you can do to protect your portfolio, to protect your home from these bad policies. There are things you can do to make money from it. And that's really the thing that I focus on every day. I spend a small part of my day explaining to people how the system works, but I spend most of my day figuring out, okay, if it's going to work this way, whether I like it or not, how do we make money for people in this? And that's really the focus, and that will always be the focus at Deep Knowledge Investing. We're never just going to throw up our hands and say, it's a bad environment, everything's terrible, go home, lose money.
Great points there, Gary. If you have any trouble or would like access to the ebook, please contact us at ir@deepknowledgeinvesting.com. Actual instructions for downloading the ebook are in the written version of the 5 things, and you can access that there as well. Moving on to thing number 4, we're talking about Texas Pacific Land Corporation. Ticker is TPL. They're getting added to the S&P 500. We saw the stock rise to about $1,600 a share level. Gary, thing number 4, TPL to be added to the S&P 500.
So TPL is a fantastic royalty company. They own an enormous amount of land in Texas, and people pay for the right to drill there and to have access to the roads and to have access to water, which you need for their business. And there are potential energy production infrastructure issues that could be a benefit for the company in the future. We added it to our portfolio. DKI subscribers started buying TPL in, I want to say, February of 2022. The stock was at 365 when we first bought it. It then ran up to right around $1,000, a little bit under that. At that point, we sold 75% of our position. The stock ran right back down to the $400, $500 level, and we bought it all back. And then last week, it was announced that TPL is going to be added to the S&P 500. The stock ran up into the $1,600, $1,700 range, meaning that from beginning to end, that stock in under 3 years has appreciated for DKI subscribers by 378%, almost 400% return on that. If you take the fact that we've traded it well and sold it high and bought it low along the way, the returns are actually much better. A lot of our subscribers have made 5, 6, 7 times their money in this name. And so it's been one that's worked out really well, and having it added to an index is even better.
Gary, one of the things I want to highlight here for the takeaway, I think this really speaks to the strength of DKI's board. If you want to give us a little bit more color and insight into what I mean by that, I believe you've had conversations with other DKI board members about TPL or even got turned on to the stock by someone within the board.
You know, Rob, I think this is something that's really important. I've been a stock picker my entire career, and I'm certainly capable of analyzing companies in a wide variety of industries. But one of the best things that I bring to the table as the CEO of Deep Knowledge Investing are my relationships with other stock pickers and the advice I get from our board of advisors. You know, remember, we had Enrique Abeda on recently talking about Talent Energy. That stock's been a double for us. And, you know, I make no secret of the fact that Enrique is the one who did the terrific work on it. I was smart enough to realize he was right, and we bought it and made more than, or about 100% on our money so far on that. I was able to partner with Dr. Paul Thompson, a cardiologist, on Shockwave, where DKI subscribers made a little over 70% on their money in under 4 months when the company was acquired by Johnson & Johnson, as we predicted it would be. I've had a lot of help. DKI board members have been very active and involved in Bitcoin even before I was. And we added that to the portfolio in 2020 when Bitcoin was around 15,000, or, roughly 1/6 the current level, 1/7 the current level. So that's up 6, 7x. This one, our profits on TPL came from another DKI board member, Chris Bell, who knows the company inside and out. He's gone through all their public filings and has just been incredible in doing multiple hour-long webinars with DKI premium subscribers, explaining the situation, explaining the investment. And it's really because of his work and his ability to explain it that we've all done so incredibly well. And so I love being in a position where, rather than take the credit, I can simply say, yeah, I was really smart because I recognized what all of these really incredible people with phenomenal knowledge about individual companies or industries brought to the table. And we used them, their knowledge, their ability and willingness to share that knowledge to help our subscribers make enormous returns multiple times. And so thanks to all of you. And thanks in particular to Chris Bell on TPL. He's done incredibly well in that name and helped the rest of us to do the same.
Yeah, and if you'd like to check out the DKI board, you can head to the website deepknowledgeinvesting.com. You can see all of the different board members that are a part of Deep Knowledge Investing. And if you haven't already, please sign up for a free subscription. All you need is your email address, and we'll get you added to our distribution list for all future content. Wrapping up today's show with the fifth thing. Again, we're moving to readers, subscriber questions. This one came in recently, an excellent question from a DKI subscriber. We're talking about hedging. Gary, how do you hedge when hedging gets more expensive? Thing number 5, is it too late to invest in those inflation hedges, Gary, that you've been talking about for some time?
So, Rob, I think this is a great question. And the reason I like it so much is it pairs really well with a question that we got a couple weeks ago from a subscriber who, was worried about having market hedges, meaning shorting market indexes against our long positions. And one of the things that I explain to people is you need to view the whole portfolio together. And so I explained that our portfolio had multiple segments. We've got an energy segment, we have individual stocks, we have market hedges to protect against declines in the stock market, and we have inflation hedges to protect against further inflation. Now, those inflation hedges, besides energy, which has been a good inflation hedge, have been things like gold and silver, and of course, Bitcoin. And so the subscriber was saying, hey, wait a minute, we've got Bitcoin at all-time records, gold just off of all-time records. Are they too high? Can we still use them? And, the answer is, I have two answers. That one is you're putting together a whole portfolio. We try to arrange things such that losses in one area will be offset by gains in another area. But the most important thing here is, and Alex knows this as well, it's something he tried to explain to the Bank of England. The thing that is causing inflation is the monetization of congressional overspending. When the US Congress overspends by $2 or $3 trillion a year, then the Treasury Department has to issue bonds, and we basically create more money. And we have more money in the system chasing the same number of goods. And when that happens, you end up with higher prices. And so, my response to this really smart question is, as long as we have overspending and an increase, a constant and increasing rate of increase in the money supply, then I want to have inflation hedges in place. And they're getting expensive, but they're getting expensive for a reason. And that reason isn't about to change.
Gary, we've talked a lot about Doge with Elon and Vivek coming into the government. Does that change your positioning in terms of if they're able to essentially or effectively try and cut these certain government programs? Does that do anything to that interest expense? What's your position with them coming into the fold here with President-elect Trump taking office end of January?
I hope they're effective. I really do. I'm cheering for Elon, for Vivek, for Doge, and for the country. We need to cut spending, and it's urgent. And I think they're pointed in the right place, and they have great intentions, and they're both clearly really smart, well-meaning people. The problem is the U.S. government is an enormous leviathan, and it's very hard to cut spending. It's hard to cut entire departments. Remember, those departments were authorized by Congress. Their spending budgets were authorized by Congress. It's not clear to me that executive orders can simply wipe out spending that's been authorized by Congress. The other thing is that everybody is against wasteful spending except the wasteful spending in their own district. Remember, every single member of Capitol Hill has wasteful spending in their district. And so they don't want to go to their constituents and say, yeah, look, I voted to reduce funding for this or for that. And on top of all of that, the only way we're going to get meaningful spending cuts is if they cut the military budget and if they cut social services, things like Social Security, welfare, pensions, Medicare, Medicaid. I don't think this administration wants to do that. I don't think they want to try to do that. And anybody in American politics who tries to do that, good luck. It's not going to work. So I hope they're successful in cutting government spending. I'm just skeptical on how much is available to be cut.
Gary, in regards to Bitcoin, because I know that's one of the positions you talk about as an inflation hedge, Bitcoin is on a run up to $100,000. Is it too late to buy? Should we sell? What's the move with Bitcoin right now?
Well, so as of today, Bitcoin had a bad weekend, a bad day. It's now down to $93,000, a
Oh
relative
my gosh,
bargain. Right. Yeah.
trouble. You
It's
were
down
wrong
to,
again, Gary.
yeah, right. Well, it's down to levels we haven't seen since last week. So it's, that's an old meme there. Um, look, I don't think it's ever too late to buy Bitcoin. Certainly it's been volatile, but the answer is that when it's volatile and goes down, that's when you buy more. We did a video last week saying you hold your Bitcoin. You do not sell your Bitcoin. If you want to buy a Lambo, you need to sell something else and use the money from that to buy your Lambo. We're every major government and central bank in the world right now is in full fiat Ponzi with just enormous amounts of spending, enormous amounts of printing. That's not going to change. And so, I think Bitcoin, with its maximum issuance of 21 million coins, of which almost 20 million have been issued, that's it. I think that's the place to be. And so, listen, if you bought it today at 93,000, and I'm just making this up, if it drops by a third tomorrow and goes to 60,000, does it really matter? Not if you were going to hold it for years, right? Just hold it. And I can tell you, a couple years ago, Bitcoin was, I don't know, I want to say 64,000. It dropped right to around 15 or
Mhm.
so. I didn't sell any. I just bought more when it got down to around 20,000 and just increased the size of my position. And I think, one of the things that's great about the Bitcoin community is they are patient, they are diamond hands, and they're just willing to hold it. And so, no, I don't think it's too late. And, at 93,000, it's a bargain compared to where it was on Friday, but more expensive than where it was a week ago. Basically, I don't know the short-term move. I don't know if the next 10 or $20,000 in Bitcoin is going to be up or down. What I do know is if you want to hold it for the next 5 or 10 years, there's not a bad time to buy it.
Gary, there's so many other coins out there in the market, right? You get this cryptocurrency market, Dogecoin, not the government entity. You've got SHIB, a whole Toad coin, whatever else there may be. Are you buying anything else there as a hedge in inflation, or is it just Bitcoin?
Just Bitcoin. One of the things I think that the Bitcoin community has done that's very, very smart is they have separated Bitcoin and crypto. When people talk about crypto and they talk about Bitcoin, Bitcoiners will say, no, Bitcoin is not crypto. And in fairness to them, it is different. It is decentralized. All of those other coins that you talked about either have unlimited caps. Doge, they can just make more of it. It's sort of like the US government and the dollar. They can just print trillions more if they wanted to. Bitcoin, it's a 21 million hard cap. That's not going to be changed. Yeah, there is a method, but you would need to get everybody. You'd basically need to get more than 50% of Bitcoiners to vote against their own interests and authorize that. The probability of that happening is right around zero. I also think proof of work matters. And the reason is because it's expensive to create Bitcoin. It's stored energy, basically, and energy isn't free. Um, and so what that means is it's cheaper, and at times it's been cheaper to buy Bitcoin than to try to create Bitcoin and pass off fake Bitcoin. It becomes very difficult to game the system. I think that's really interesting, and the fact that it's decentralized means it can't be controlled by one person or somebody who can just change the rules. And we've seen that in other crypto projects. I know the Ethereum community will say, hey, we've got better use cases. There should be growth on that. And those are fair points. And ETH does have, some really impressive use cases and the ability to build on that. All that's terrific. The problem, in my opinion, with ETH is that it's proof of stake, not proof of work. It's easier to create and it is centralized. You have, a small number of people who can change the rules. This is a situation where I want to own Bitcoin for years and just hold it and not really concern myself with a whole bunch of other non-Bitcoin crypto. If I'm going to be investing in something else like that, my real talent and my real expertise is as a stock picker, and I'm going to find, the next stock that DKI subscribers can own that can double or triple or better. And, as we were talking about earlier in this episode, we've had a lot of examples of that. So that's really my focus.
Gary, one last question, and I think we got Alex that's going to add a few points here for the fifth thing. When you talked about implementing inflation hedges, you mentioned dollar cost averaging. What's dollar cost averaging? Why is that a good way to jump into the market, regardless of where the current price of an asset may be, in this case, Bitcoin?
Sure. So a lot of times people will say, I want to own a certain number of shares or a certain amount of Bitcoin or a certain dollar amount of something, and they just go buy it. Now, for people who are saying, well, I want to own Bitcoin, but I'm worried that the current level, whether it was 100,000 or the 93.5, which is where it was just before we started the show, um, they might say, well, I'm worried. I want to own it and be there if it goes up, but I'm worried that what if it goes down to 50,000 and then, I feel like a sucker and, then I've lost money. And so what dollar cost averaging is, let's imagine for a minute that what you can spare in your household budget is a certain amount of money per week or per month. Let's just say monthly, whether it's $100 a month or $500 a month or $1,000 a month, whatever works with your budget or your family's budget. What you would do is every month in this example, you would buy that same $100 or $1,000, whatever that number is, amount of Bitcoin. And the reason you do that is because when Bitcoin goes down or when the stock that you're looking at goes down, that $100 will buy more Bitcoin. It'll buy more sats. It'll buy more shares of the stock that you want. When it goes up, when the stock goes up or Bitcoin goes up, that $100 will buy a smaller number of sats or a smaller number of shares. And so with dollar cost averaging, it is a guarantee that you buy more when it goes down and you buy less when it goes up. And you're just buying over time. And so the math on it does work. It's not something that I typically do myself. Usually I've, picked investment exposure that I want, and sometimes I'll scale into something, but typically I know what bet I want to make and I make that bet. But for people who aren't doing this all day, every day, or who are worried, I want to buy Bitcoin, but I'm worried that it's too high, dollar cost averaging across a year or two is a perfectly good way to make those investment allocation decisions. And the other thing is, if you do it automatically, it just comes out of your account and you don't have to think about it. And it's sort of this forced savings and this forced investing. And if you do that across a number of decades, you can end up with a lot of money in your account down the road. And that's not a bad way to invest either.
Alex, wanted to open it up to you for thing number 5. Anything that you would add? Any insights from you?
Sure. I mean, I would just reiterate kind of what Gary said. I mean, Bitcoin and gold have had a great, well, gold has had a great run in the last year, and Bitcoin, well, in the last year, it's also had a great run. And we've seen kind of Bitcoin have a small pullback in the last few days. And then gold has also kind of tanked a little bit. So that kind of just really hammers home that point of dollar cost averaging. In terms of inflation hedges, I completely agree that they're getting even more important no matter how much more expensive they're becoming. And so as much as, I side with Gary on the, hoping Elon Musk and Vivek and whomever else part of Doge sort out kind of the US fiscal situation. Like Luke Roman makes a really good point, which is that the actual true interest expense, which he kind of calculates as entitlement spending, defense spending, and the real interest on the debt is already in excess of 111% of gross federal tax receipts. So kind of this like inflationary wave is probably not going to stop. And although there will be volatility, they are very important. And I would just highlight one extra thing. There's been a lot of talk recently about the strategic Bitcoin reserve. And I think everyone's been very excited about it because of, well, I think what it could mean for the price. But I read a great thread the other day by TXMC Trades on Twitter.
I
And
follow him.
he's fantastic, and
Yeah.
he showed that Bitcoin would essentially have to outgrow that. Even and these are the CBO projections; these aren't even, and we know how off they are. It would have to grow, I think, 30% and growing in perpetuity. And as it becomes a larger asset class, that's going to be more difficult. So I think I'm not too bullish on the strategic Bitcoin reserve, but I think, yeah, Bitcoin and gold, they're very important no matter how expensive they get going forward.
I'm gonna add one thing to this. I just want our very sharp viewers to notice that the term Alex used was federal tax receipts. At Deep Knowledge Investing, we never talk about taxes as revenue. Revenue is a voluntary exchange for goods and services. Taxes are not voluntary, and you may not be receiving any goods or services or anything that you think has value. Yet again, Alex, we're very proud of you for understanding that tax receipts and revenue are not the same thing. When you are done embarrassing the Bank of England, we will send you to Washington, D.C., and you should have a chat with the Federal Reserve governors there.
Next on my hit list. Yeah.
Line them up. That concludes this week's version of the five things. Thank you, everybody, again for tuning in. This was the Nvidia calms the market issue. As you've seen just with our fifth thing, if you have any questions that you'd like to ask Gary or the DKI team, please don't hesitate to reach out. You can do that in one of two ways. You can head to the website, use the Ask Gary link in the navigation. That'll take you to a form. Super simple, easy to fill out, submit your question. You can always email us as well at ir@deepknowledgeinvesting.com. That'll wrap up this edition of the five things. Gary, I'll turn it over to you for any closing thoughts.
Well, it's Thanksgiving week, Rob, and I think it's a really important holiday. There's something wonderful about any holiday, whether it's a national one or a religious one, where we focus on gratitude. And so, today I just want to express gratitude to you, Rob, for filming this with me every week. Alex, you and Andrew do an incredible job as interns. And for our audience, I say this to you guys every week, but we know your time is valuable, and thank you so much for spending it with us. It's exciting and fun for us to do these videos for you and to think about what issues we want to highlight every week. And so we are all thankful for all of you. Thanks for watching, and we will see you in next week's video.
Thanks so much, everyone.
Take care.